Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, January 29th, 2017. Please excuse my voice. I've been actually doing at fundraiser events going from Wednesday, Thursday, Friday, and Saturday, and I think I just kind of talked my voice out. But anyway, let's get started. There's really not a whole lot to report. What we know is that the market's been on a tear since Trump's been elected, and it's weakening. Even though we've had some decent up days, down days are getting bid back up. The rate of change is what is happening, and that typically happens towards the top. Now, does it mean that we had to make a top already? It would make perfect sense because one of really the variables that I was looking at was the Dow getting to 20,000 and the S&P getting to 2,300, and they both did it. They don't really make any difference as far as those numbers, but whenever we're close, it just seems like a magnet. Like the market's not going to really break down at all until those important numbers are hit, and so they were both fulfilled last week. We have Nothing has really changed as far as the patterns and what's in play and why I believe there's more points to the downside than there is the upside. So we know we have bearish divergences on the daily chart. We have this bearish rising wedge that it broke through and has been kind of hitting the top of it. Now, what the bears have to do, and we're really not going to get any type of breakdown until they really get through the anywhere from the 2254 down to the 2234. This is the important support level. If they break that, then I think we have a panic reaction trade down to at least the 2885, 2185. And really, the important, most likely, there's going to be a lot of buyers waiting, will be down at this 2156. But from 2300, if it gets all the way down here, you can see why I'm more interested on a short-sided trade than a long, because I don't I do believe that we're in some type of topping process right now, and maybe it has to go up 10, 15 more points. We'll have to wait and see on it. It's going to top when it tops, but even if that's the case, we still have 150 points to the downside. So that's the reason why I am only interested on the short side here. And I took my last one at 22.99, so it was an okay fill. My first one was at the 22.76, so I'm averaged in right around I say the 22.90 in that range with my full position. If we take a look at the 60-minute chart here, you can see we have bearish divergences, but sometimes it takes a couple say well-formed bearish divergences before we have a reaction to the downside. But being we have one, two, three, and kind of four right here, it may not have to have a well-defined bearish divergence. We know we're very overbought right now. MACD has already crossed. And another reason why I'm in the bears camp from here for this trade is we have 1, 2, 3, 4, and wave 5. So when that happens, we typically get anywhere from a 38% is really the low end of it, but more likely 50 to 78% retracement of this move right here. So again, that brings us back into that 150 point move to the downside, and why I'm more interested on a swing trade down instead of up. If we take a look at the 15-minute chart, bearish divergences on that, you can see that they did burn off the extreme overbought readings there, they've kind of held things up. And this does look like it could be some type of bull flag, and that would kind of hint that we would have another push to the upside. But remember, every time they've tried to gap up from already high levels, this gap has been filled, or failed, where anybody that bought it up here on the gap up is going to end up underwater, because it's going to end up coming back down to these levels. Now, again, history could change, but every single one, it's actually 100% trade that wherever the gap has taken place, the S&P has come and traded below where it gapped up. So you can see we have the 200-day moving average here, and that's right around that 2278. That would fulfill this gap up failure if it did get there. And really, that's about it. If they head higher, keep an eye on the 2305, 2310. There's not really too many other, say, ways to judge where it might turn, so you just look at the round numbers. If the Bears can push it through to 2290, we should get that reaction trade down to the 2284, which is the support here. If they lose that, then we come down to the 2278. So those are the support areas that the Bears have to push through. And the one thing is, we're trading below the 50-day moving average on the 15, so we can see there's resistance at the 2296, and then we also have it at the 2298, and then the 2301. So if the Bulls can push it above that, that's when you start looking at the 2305, 2310. And if they open down below it, that's when you start looking at the support levels. So that's really about all I have for today. Enjoy the rest of your weekend, and I will talk to you guys in the morning.